What if I told you that the obvious conclusion here, that this is just another wild, unsustainable, speculative pump, is fundamentally, completely wrong? What if the numbers Nebius just dropped were so insane that they didn't just beat Wall Street's expectations, they shattered the entire bearish narrative that dozens of professional short sellers had built their positions on? Because underneath today's explosive price action lies something far rarer than hype. It's a devastating combination of unstoppable operational leverage, a beautifully elegant trap that crushed the shorts, and a genuine paradigm shift in how AI cloud companies fund their explosive growth. Today, we are going to dissect the complete anatomy of this breakout. We're going to look at exactly how the data predicted this precise move before it even happened, how a legendary short seller got caught on the wrong side of the trade, and ultimately, figure out how much higher this rocket ship can realistically fly from here. That all sounds impressive, right? But it gets even better once you look at how the entire market tipped its hand a full 24 hours before Nebius even revealed a single number. Hey, if you find breakdowns like this one valuable, do me a quick favor and smash that like button and subscribe. It genuinely helps the channel grow and lets me keep dissecting these plays for you. Alright, let's get into it. To truly understand why today's breakout was so violent, so aggressive, we have to rewind the clock back to yesterday's massive market setup, because the stage was already being set. Sector pioneer CoreWeave dropped its own second quarter earnings report, and it established a phenomenally high bar for the entire NeoCloud group. How high? Try a staggering backlog of $104.2 billion. Let that number sink in for a second. This report acted as a crucial macro proxy for the whole industry. It sent a crystal clear signal ringing through every trading desk on Wall Street. Institutional demand for AI compute is not cooling down. It's not plateauing. It is actively accelerating. And almost instantly, the market re-rated the entire group of AI cloud players. Traders started connecting the dots, pulling Nebius shares up a full 8% in sympathy. And here's the wild part. This happened before Nebius had even released a single financial figure of its own. The sector was coiled up tight like a compressed spring, just sitting there, waiting for the operational fuel to ignite it. But here's the fascinating twist. Before that earnings fuel was even poured onto the fire, a strange little localized regulatory bottleneck handed patient investors what might be the ultimate pre-earnings entry point. So how does a boring zoning dispute create a golden buying opportunity? On August 11th, just one single day before earnings were set to drop, local gridlock over the Vineland data center expansion hearing triggered a temporary wave of panic among nervous investors. This fear dragged Nebius shares all the way down to a session low of $184.11. Now, for the disciplined, informed investor, this wasn't a reason to panic and run for the exits. It was a gift wrapped up with a bow on top. We had specifically identified this exact $180 to $185 range as the high-conviction entry zone. And right on cue, buyers stepped in aggressively to defend this dynamic support shelf. From that exact bottom, the stock proceeded to execute an absolutely flawless technical launch sequence. In the pre-market session today, the first upside target at $200 was completely smashed to pieces. Just minutes later, the second target zone at $210 to $215 was cleared with ease. And then, once regular session trading opened up, buyers pushed the shares straight into our ultimate target zone, peaking somewhere between $223 and $234. Now, achieving a clean 21% intraday move is one thing, but how you actually play that kind of volatility is what truly separates the amateur traders from the seasoned professionals. And this next part is where a lot of eager beginners got absolutely burned today, even though they technically bet on the right direction. How is that even possible? Going into this massive earnings event, the options market was pricing in nothing short of absolute chaos. Pre-earnings implied volatility spiked to an astronomical 157%. So imagine you're a beginner trader. You feel confident. You think, Nebius is going up, so let me buy some cheap short-term call options and get rich overnight. Well, if you did exactly that, you very likely got absolutely crushed today, despite the stock surging higher. Why did that happen? It's a phenomenon known as a volatility crush. The very second those blowout numbers were officially released, all that uncertainty vanished into thin air. That astronomical implied volatility instantly evaporated, and it took the inflated option premiums right down with it. Those expensive contracts you bought lost enormous value even as the underlying stock climbed. But by avoiding that seductive temptation of expensive options and instead choosing the direct equity path, disciplined investors completely bypassed that brutal premium decay. They captured the pure 15 to 21% upside of the actual stock movement, with zero derivative drag holding them back. And that brings us squarely to the actual numbers that dropped this morning, the fundamental engine that is driving this entire incredible move. So just how good were they, really? When the press release hit the wires before the opening bell, the sheer scale of Nebius's growth caught the entire street completely off guard. Group revenue didn't just grow. It soared a jaw-dropping 454% year-over-year, landing at $582.3 million. That handily blew past every consensus estimate analysts had penciled in. The powerhouse engine behind all of this growth is their core AI cloud segment, which now accounts for a dominant 98% of their entire business, pulling in $575 million all on its own. That relentless operational momentum has pushed their annualized revenue run rate to a truly massive $3 billion as of the end of June. And management? They were so supremely confident in the durability of this demand that they officially upgraded their year-end contracted power target to a colossal 5 gigawatts. That all sounds incredibly impressive on the surface. But it gets even more shocking once you look at what was happening underneath that top-line revenue number, because the real surprise of this entire report was hiding just below the headlines. For several quarters now, Wall Street analysts have been sounding the alarm, warning that Nebius would inevitably see severe margin compression. Their logic seems sound. The company was pouring enormous amounts of capital into building out infrastructure well ahead of the revenue that would eventually justify it. But today's report delivered an unprecedented profitability shock that flipped that entire thesis on its head. Adjusted EBITDA did not compress. It absolutely exploded. It swung from a $21 million loss in the same quarter last year all the way to a positive $236.2 million today. That represents a spectacular 40.6% adjusted EBITDA margin. So what does that number actually tell us? It reveals that Nebius's underlying unit economics are wildly, incredibly profitable the very second their capacity comes online and gets activated. This showcases a level of operational leverage that very few scaling technology companies ever manage to achieve in their entire lifetime. But scaling a global AI cloud empire requires billions upon billions of dollars in specialized, cutting-edge hardware. And that brings us to the one burning question that investors actually care about above all else. How on earth are they going to pay for all of it without destroying their shareholders? Typically, hyper-growth infrastructure companies are stuck with two ugly choices. They either have to dilute their existing shareholders by issuing tons of new stock, or they take on mountains of toxic high-interest debt to fund their expansion. But Nebius is doing something completely refreshingly different. They officially validated 4 landmark AI cloud contracts, each one averaging over $1 billion in value. But here is the absolute kicker, the part that changes everything. Their customers, and we're talking about major serious players like Cohere and Reflection AI, are fronting massive prepayments upfront just to secure guaranteed future capacity. In 2026 alone, Nebius has already locked in a staggering $9 billion in customer prepayments. And these prepayments are covering somewhere between 50 and 60% of the associated capital expenditures. Think about what that actually means. It means Nebius's rapid, aggressive expansion is essentially being self-funded organically by its own customers, drastically slashing the need for any dilutive equity raises down the road. This powerful combination of blowout earnings and organic self-funding was an absolute dream scenario for the bulls. But at the very same time, it was creating a genuine nightmare for a completely different group of market participants. And what happened to them next was nothing short of brutal. Heading into today's earnings print, Nebius was sitting there as one of the most heavily shorted AI infrastructure stocks on all of Wall Street. Short interest was sitting at a massive 24 to over 28% of the available float. Just think about how crowded that trade was. This set up an incredibly dangerous time trap for the bears who were betting against the company. With a high days-to-cover ratio of 3.5 days, it would take over 3 full sessions of average trading volume for all those short sellers to actually exit their positions. There simply wasn't enough liquidity for them to escape quickly. Add in an extreme skew in the options market, where the put-to-call ratios sat at a highly lopsided 1.47, and what you had was a stock that was fundamentally under-owned on the long side. So when the good news hit, today's massive gap up became a dual-engine rocket, simultaneously fueled by frantic short covering from trapped bears and brand-new institutional buyers piling in all at once. But this squeeze wasn't just some random trading phenomenon. It was a direct, humbling challenge aimed at the most famous short seller on all of Wall Street. You probably know the name. Michael Burry, the legendary investor made famous by The Big Short, had reportedly initiated a massive short position on Nebius at $211.77. His core thesis was actually pretty clever on paper. He argued that AI operators are overstating their true economic profits by depreciating their high-end GPUs over slow, generous 5-year cycles. His point? These chips will likely become functionally obsolete in just 2 to 3 years, meaning the real costs are being hidden. And if you look purely at Nebius's GAAP net loss, which actually widened to $190.4 million, largely due to a surging $259.7 million in depreciation and amortization, then Barry's paper accounting warning genuinely looks valid on paper. But here's the thing. In the real world, cash flow is king, and Nebius is sitting on an $8 billion cash fortress, supported by those enormous customer prepayments we just talked about. This leaves the company completely insulated from the balance sheet destruction that Barry so confidently predicted. So how do they keep this incredible capital efficiency going? The secret lies in their genuinely unique operating framework. To truly appreciate the massive long-term runway here, you absolutely have to understand the soperator model. That's short for software plus operator. Instead of taking on crushing debt to build physical data centers from the ground up, Nebius does something clever. They let outside financial partners fund the heavy, expensive real estate and power infrastructure. Then Nebius simply steps in as the operator. They layer their own proprietary AI software, their specialized network architecture, and their entire optimized software stack right on top of that third-party hardware. This brilliant asset-light model allows them to scale their capacity at an absolutely blistering pace without choking their own balance sheet under the weight of heavy capital expenditures. It's a beautifully efficient loop, funded by partner capital, optimized by Nebius software, and guaranteed by cold, hard customer cash. But physical infrastructure is honestly only half of the battle here. In this cutthroat industry, your growth potential is completely capped by one thing: your access to physical silicon. So how does Nebius win that war? Well, while other cloud providers are practically begging and pleading for chip allocations, Nebius holds a genuinely unfair advantage. Nvidia itself holds an active 9.3% equity stake in the company. Just think about the implications of that. This strategic backing practically guarantees Nebius priority access and allocation of next-generation systems, like Nvidia's hotly anticipated upcoming Vera Rubin architecture. This lets them completely bypass the crippling supply bottlenecks that are currently strangling their competitors. And because of this supply security, Nebius commands truly extreme pricing power. Their capacity is completely sold out, gone. And their most recent capacity auction cleared at 15% above the highest previous Blackwell price, with premium short-term deals reportedly closing at a staggering $40 to $50 million per megawatt. Let that sink in. They aren't just selling cloud compute anymore. They are effectively auctioning off the single rarest and most valuable commodity in the entire modern economy. And when you combine that level of pricing power with a locked-in supply chain, is it really any surprise that Wall Street analysts are now aggressively racing over each other to revalue this company? The consensus rating among Wall Street analysts is now firmly sitting at overweight, and today's blowout print is going to force a massive wave of upward target revisions across the board. Let's look at where the big names stand right now. Goldman Sachs maintains a buy rating with a $286 price target. Robert W. Baird is sitting at $250. Citigroup is at $278. And then there's Northland Securities, representing the ultimate bull case, setting an eye-watering target of $410. That single target represents roughly 80% of additional upside from today's regular session highs. Is that even possible? Well, this incredible bullishness is anchored by an unparalleled backlog, with Nebius commanding somewhere between $44 and $46 billion in total potential commitments from absolute Tier 1 giants like Microsoft and Meta. So with the stock gapping up 21% today, what exactly is the tactical game plan for the active swing trader looking to profit right now? For the short-term swing traders watching this, today was the ultimate validation of our entire target strategy. That tactical profit-taking target of $225 to $230 was hit absolutely flawlessly during the regular session. So what now? Right now, the immediate level to keep your eyes glued to is the major weekly R1 resistance sitting at $219.55. Here's the key insight. If the stock fails to close the week firmly above this critical level, short-term traders should seriously look to take their remaining profits off the table. Why? Because the acute short covering momentum that fueled this move will naturally begin to cool off over the following 2 weeks. And below that key level, the previous close sitting at $193.23 will serve as our key support and technical floor. But if you happen to be looking at this company through a much longer-term lens, then honestly, all this daily noise of short squeezes and resistance lines becomes almost completely secondary. For the long-term investors out there, the blueprint here is incredibly, refreshingly clear: strong buy and hold. Today's earnings didn't just beat expectations by a little bit, they fundamentally de-risked the entire long-term investment thesis in one fell swoop. That 40.6% adjusted EBITDA margin proves, without a doubt, that this business model is deeply profitable. The asset-light soperator model ensures ongoing capital efficiency, and that active Nvidia equity stake fiercely protects the all-important supply chain. So if you're focused on building a serious core long-term position, my advice is to simply ignore the short-term squeeze volatility and all the daily drama. Instead, view any market-driven pullbacks toward that $193 support area as genuine golden opportunities to accumulate more shares at a discount. And finally, let's look toward the immediate horizon, because there are two major catalysts waiting in the wings, ready to write the very next chapter of this remarkable growth story. Mayhem, as we look just a little bit ahead, this breakout is very likely far from over. On August 17th, Nebius faces the highly anticipated Vineland zoning hearing. A positive outcome from the planning board would completely eliminate the bearish delay thesis that spooked investors earlier, and it would unlock a massive technical path pushing shares toward those higher Wall Street targets we discussed. Then, shortly after, on August 25th, the company's annual general meeting will provide critical updates on their massive 1.2 gigawatt Pennsylvania facility, and it should officially put to rest any lingering dilution fears that skeptics still cling to. Now, before we wrap everything up, a quick but important word. Everything shared in this video today is intended strictly for educational and informational purposes only. It is absolutely not financial advice. I am not your financial advisor, and I don't know your personal financial situation, your risk tolerance, or your investment goals. The stock market carries real risk, and you can lose money. So please always do your own thorough research and consult with a licensed, qualified financial professional before making any investment decisions of your own. With all of that said, let's bring this home. Nebius just delivered one of the most impressive earnings reports the AI cloud sector has seen this year, shattering revenue expectations, flipping to shocking profitability, self-funding its expansion through customer prepayments, and crushing a small army of short sellers all at the same time. Whether this rocket keeps climbing toward that $400 bull case or cools off in the coming weeks, one thing is crystal clear: this is no ordinary AI hype story. Now, I genuinely want to hear from you, so drop this in the comments below. If you had $10,000 to put to work today, would you buy Nebius at these elevated levels chasing the momentum, or would you patiently wait for a pullback toward that $193 support zone? Let me know your strategy, because I read every single comment. And if this deep dive brought you real value, please take 1 second to smash that like button and subscribe to the channel so you never miss the next big breakdown. Thanks so much for watching.